What's going on, everybody? Charles Boone here with Prosper Trading Academy, and today I am going to show you 3 chart patterns you must know. Now, for those that are like veterans of the market, you may already know these, but this is more for those that are just trying to get started. These are very popular out there. There's tons of content out there, but I want to describe exactly what these patterns are and what they actually mean and how you could use these to your advantage. The first one is really popular here. You may have even heard of it before. It's called the head and shoulders pattern. And it's exactly what you think it's going to be. Now, the head and shoulders pattern basically is tied to 3 peaks, okay? 3 peaks is going to be an important aspect because this is what's known as a reversal down pattern. It means that it's predicting that the stock price is going to go lower and maybe even drop a lot. Now, there's also something that's known as the inverted head and shoulders. The inverted head and shoulders would be like if you took your monitor and flipped it upside down, and instead of the predictable drop in the stock price, it would actually showcase that the stock is ready to rally. It's the same pattern. One would be right side up, the other would be right side down. Now, let's talk about the 3 peaks. Just like you see here visually, it would be my shoulder, my head, and then my shoulder. Basically, the 3 peaks that we're going to talk about here, the first and the third peak would be aligned in the same price range, and then the head would be the mid peak, which would be slightly higher. So in essence, guys and gals, it would be here, it would be up, and then it would be here, and then the drop. This chart pattern has been widely used and it's widely watched. That's why it's so successful, is that there's a lot of market participants that are looking at this formation. Generally speaking, upon the rejection of this particular price level, that first shoulder, that's where you get the first indication. And when we start seeing lower lows stack up day after day, we already know that the pullback is going to occur. That's when short sellers get active or buyers look to scramble out of their position. Pretty simple. If you were shorting, your stop would be just above that third peak high, and you're looking to ride it as low as you can. Now, the inverse in this aspect will be when a stock hits a bottom, it drops lower, it rallies back, and on that third bottom test, the shoulder, remember, you're turning it upside down. So imagine I am flipped upside down at this moment. Upon that shoulder, we find support at that first shoulder price level. So to give you an idea, if that first shoulder level was $20, and then that mid peak, that inverted head, is at $15, and then the third shoulder support comes in at $20, guys and gals, the stock chart is showcasing a potential reversal higher. Now, how far it could go, obviously that's dependent on momentum. We've covered momentum in other videos as well, but this chart pattern could pay off great. Why? Because you could be buying in at great value in a stock that you like. This inverted head and shoulders pattern is an extremely bullish sign, and if you could recognize it properly, it could be a very rewarding chart pattern opportunity. And that same thing, if you recognize the actual head and shoulders pattern, it could save you a lot of heartache in stocks that you are long in, or it could give you an active reason to become a short seller. The second pattern I want to talk about is the cup and handle. A lot of the times, cup and handles could be in stocks that are down huge off the highs, or they could be within the context of an uptrend. Now, I know that sounds a little bit confusing, but all in all, the chart pattern is pretty simple. It starts to cup. Think of the letter U. U as in unity. The reason why we say U is that if you pull up a U like this, you can see how it just kind of hits that flat portion on the bottom and starts to curl back up. So if you ever drink coffee in the morning out of a coffee mug and you take a look at it, you can see the shape of the coffee mug itself. The handle will be the actual handle of the coffee mug that you're holding here. Think about it like this. A big U formation and a recovery, a small pullback, and then a reversal up. Now, what's really important is the point of where the U would start and where it breaks out from. That breakout point would be that high peak or the top of your cup. The cup and handle showcases a great trading opportunity. Now, for those that are very fluent with this opportunity, before the chart formation actually starts to curl up, you could actually see buyers buying in at the basing portion or the bottom portion in anticipation. But say you missed that opportunity, the handles where you would have to look. On that second and smaller U, you will be looking to either buy in on the dip there or play the breakout above the peak or the top of that cup. It sounds a little confusing when you look at the chart, and I'll show you how it looks out. You'll understand the dynamics and the actual entry points or possibility. This also could be used as a trade management aspect. Number one, if you're already long the stock, maybe you bought in at a certain price point and you see this chart pattern and it ends up triggering higher, it may cause you to hold it a little bit longer and have a little bit of conviction and extend on your gains. But if you missed on the initial opportunity, that handle portion is where you can find a great low risk, high reward scenario for a potential breakout play by buying in on the dip. This chart pattern, again, is also widely known and widely used and widely watched, which is why it has success, because if there's market participants that are looking for the same thing as you are at the exact same time, and everybody starts buying in, that's going to cause the market dynamics to change. Why? Because now all of a sudden we're seeing buy side participants and they're all coming in. Usually when there's a lot more buyers than sellers, the stock price goes higher. The third one is going to be called the 1, 2, 3 or the ABC. Now, a lot of this is tied to a more complex strategy called Elliott wave theory. Realistically, folks, I just want you to think about it as stair stepping higher. We all know what stairs look like, right? So equate those stairs to the chart itself. Basically, it goes up another step, and up another step. The dynamics of 1, 2, 3 is to recognize it on 3 when the stock is turning up. The reason being is this basically becomes a buy the dip scenario in a stock that is starting to turn higher. When I talked about my W formation earlier, it's really 1, 2, 3, 4. So think about taking out this portion here and making it look like an N as in Nancy. Ultimately, guys, when it pops up and it pulls back and it starts to create that second leg higher in N, that's the stair step that we're looking for. In essence, the stock price is trying to create a staircase, aka a higher uptrend. And this is an early indication that we could see in terms of dynamics that we should be a buyer on the dip with the potential of this stock trending higher, breaking above highs, and continuing their run. And as long as the stock is stair stepping up, you should be holding long. This really comes down to just knowing the basics of what a trend is. Higher highs and higher lows. Again, we've talked about this in previous videos, but this dynamic is so important that even veteran traders tend to forget to look at it. Make sure you always cross-reference, guys and gals. If you're looking to be a buyer and the stock is in an uptrend, your level of success is going to be higher than trying to be a buyer in a downtrending name. Remember, momentum is one thing, and if the long-term momentum is on the buy side, guess what? The current of the ocean is in your favor. If you folks have ever swam in the ocean and you swam against the current, you know how difficult it is. Well, imagine, even if you have $1 million account, what that does in reference to the ocean of the stock market. Your $1 million is barely a drop in the bucket. So that should tell you it's probably best to trade with the current of the ocean as opposed to against it. The saying in the market is the trend is your friend. And if you just outline that scenario, if you were, stranded in the ocean, you're miles from shore, do you want to swim against the current or do you want to swim with it? Your chances of survival is much, much greater when you swim with the current as opposed to against it. All right, folks, if you happen to like the content that I dropped today, do me a favor, like, comment, and subscribe. Click on that notification bell. Give me your thoughts on these three chart patterns in the comment section. Let us know if there's something else that you want us to cover. And guys and gals, thanks for watching. Peace and love all.